Imagine opening your brokerage app on a Tuesday morning. The screen is a sea of red. You refresh it, hoping it is a glitch, but the number drops another 2% right in front of your eyes. You have $10,000 in there, or at least you did last week. Now it is sitting at $6,000 and falling fast. Your stomach drops, your palms sweat, and a very loud, very primal part of your brain starts screaming at you to sell everything before it hits zero. This isn't just a hypothetical nightmare. It is exactly how millions of investors lose money every single year. We like to think we are rational creatures who make decisions based on spreadsheets and logic. But when real money is on the line, we are emotional wrecks. The first and perhaps most dangerous mistake new investors make is letting those emotions drive the bus. I have seen smart people, doctors and engineers with high IQs, sell at the absolute bottom of a market crash simply because the pain of watching the numbers go down was too much to bear. It is the classic buy high, sell low dynamic. But it never feels like a mistake in the moment. In the moment, it feels like survival. If you are serious about building wealth, you have to treat your emotions as a liability, not an asset. Before we dissect exactly how to wire your brain to resist this urge, take a second to hit that subscribe button. Consider it the best ROI on your time today, investing in the knowledge that keeps you from making expensive errors. Now, let's look at why our brains sabotage our wallets. The flip side of panic is euphoria, and frankly, it can be just as destructive. When the market is roaring, everyone looks like a genius. You see your neighbor making money on some obscure tech stock, and you feel that itch. It is the fear of missing out, or FOMO, and it pushes you to buy assets that are already overpriced. You are buying high because it feels good, because everyone else is doing it. But the market has a cruel sense of humor. Usually, right when the euphoria peaks, the correction begins. I remember back in the dot-com bubble, people were quitting their jobs to day trade because they thought stocks only went up. We know how that story ended. The fix here isn't to become a robot, because that is impossible. The fix is to have a written plan that you created while you were calm. Think of it like a flight plan. A pilot doesn't decide where to land when the engines are on fire. They decide before they even take off. You need rules. If the market drops 10%, what do you do? If it rises 20%, do you rebalance? By answering these questions now, you remove the decision-making process from the heat of the moment. Automation is your best friend here. If you set up automatic contributions, dollar-cost averaging into the market, regardless of whether the news is good or bad, you effectively bypass your own psychology. You are buying more shares when they are cheap and fewer when they are expensive, all without lifting a finger. This leads us directly into the second major pitfall, which is chasing high returns. We have all seen the headlines about the guy who turned $1,000 into $1 million overnight on some meme coin or penny stock. It is intoxicating. It makes reasonable returns of 7 or 8% feel boring, almost insulting. But here is the reality check I have run the numbers on. High returns are inextricably linked to high risk. There is no free lunch in finance. If an asset has the potential to double in a month, it has the potential to go to zero in an hour. When you chase these hot assets, you are usually arriving late to the party. You are the one buying the drinks after the smart money has already left the building. I often compare this to betting on horses based on which one has the coolest name. Sure, you might win once, but it is not a strategy, it is gambling. The danger here is that you stop looking at fundamentals. You stop asking if a company makes a profit or if a currency has utility, and you start asking if it is going to the moon. That is a recipe for disaster. If you don't understand why an asset is rising, you won't know when to sell it, and you certainly won't know what to do when it crashes. You end up holding the bag. The antidote to this greed is a heavy dose of boredom. I know, nobody wants to hear that the secret to wealth is buying a broad index fund and waiting 20 years. But the math is undeniable. By diversifying and sticking to proven strategies, you protect yourself from total ruin. It is about staying in the game long enough for compounding to work its magic. Think of your portfolio like a diet. You can try the crash diet where you starve yourself to lose weight fast, which usually ends in a binge. Or you can just eat healthy consistently. One is exciting and dramatic, the other actually works long term. Avoiding concentrated bets on trendy assets doesn't mean you can't have fun. If you want to take 5% of your portfolio and throw it at something speculative, go ahead, call it your Vegas fund. But don't bet the mortgage on a hunch. The goal is to get rich carefully, not quickly. Quick wealth is usually just a loan from the universe that you have to pay back with interest. But here is the twist that catches almost everyone off guard. You might look at your portfolio and think you are safe because you own 10 different stocks. You have some Tesla, some Nvidia, maybe some Amazon. You think, I am diversified. I own 10 things. But that is false security. This brings us to mistake number 3, a lack of true diversification. Owning 10 different tech companies isn't diversification. It is just a really complicated way to own the tech sector. If the tech sector takes a hit, your entire portfolio sinks. True diversification is about correlation, how assets move in relation to one another. You want things that don't move in lockstep. When stocks zig, you might want bonds or real estate to zag. I've seen portfolios that look like a grocery list of the S&P 500's top performers, and the owners are baffled when they lose 30% in a correction. They fell for the winner-take-all myth, assuming that if they just pick the best companies, nothing can go wrong. But even the best companies are subject to market cycles. If you put all your eggs in one basket, or even in 10 baskets that are all sitting on the same shaky table, you are exposing yourself to severe losses. So how do we fix this? We have to build a fortress, not just a fence. You need to look across asset classes. We are talking stocks, bonds, maybe some real estate investment trusts, or even commodities. The easiest way to do this without spending your life analyzing charts is through ETFs or index funds that cover the total market or international markets. By buying the haystack instead of looking for the needle, you guarantee that you will capture the market's return. You won't beat the market, but you definitely won't be beaten by it. And you have to maintain this. A portfolio is like a garden. If you don't tend to it, the weeds take over. If your tech stocks double in value, they now make up a huge chunk of your risk. You have to sell some of the winners and buy some of the underperformers to get back to your target allocation. It feels counterintuitive to sell what is doing well and buy what is doing poorly, but that is literally the definition of buying low and selling high. It forces discipline on you. I remember talking to a guy who had everything in oil stocks back in 2014. He felt like a genius until the price of crude collapsed. He didn't just lose profit, he lost principal that he could never get back. Don't be that guy. Spread your bets. Mistake number 4 is something we are all guilty of in other parts of our lives. But in finance, it is fatal. Neglecting research. We will spend 3 weeks reading reviews for a new toaster, watching unboxing videos, and comparing warranties. But then we will dump $5,000 into a company because a guy on a forum said it was going to pop. It is absurd when you say it out loud, but people treat investing with less scrutiny than their grocery shopping. Jumping into investments based on tips, trends, or media hype is akin to gambling with a blindfold on. You are playing poker against people who can see your cards. If you don't know how a company makes money, you have no business owning it. I've seen people invest in biotech firms without knowing if they even have a drug in phase 3 trials. They are buying a ticker symbol, not a business. And when you buy something you don't understand, you have no conviction. The moment the price drops, you panic because you don't know if the drop is a buying opportunity or a signal of impending bankruptcy. You are flying blind. I know reading financial statements is about as exciting as watching paint dry for most people. But you don't need to be a forensic accountant. You just need to understand the basics. Read the official documentation. Look at their debt. Look at their cash flow. If a company promises returns that sound too good to be true, they are. Period. There is no secret algorithm that generates 20% risk-free returns. If someone offers you that, run the other way. By learning the basic principles of valuation and risk, you inoculate yourself against scams and hype. You start to see investments as ownership stakes in real businesses, not just lines on a chart. It changes your perspective. You start asking questions like, does this business have a moat? Is the management team competent? These are the questions that save you money. It is the difference between being an investor and being a spectator who is betting on the jersey colour. Do the work or pay someone who does. There is no middle ground where you guess your way to fortune. Now, here is the hidden cost that nobody mentions. The most dangerous time for a new investor isn't when they start, it is right after they win. This leads to mistake number 5, overconfidence. You buy a stock, it goes up 30%, and suddenly you think you have cracked the code. You think you have a special intuition for the market. This is the Dunning-Kruger effect in full swing. Initial success fosters a misleading sense of skill. You start taking bigger risks, ignoring the safety rules you set up in the beginning. You stop using stop losses. You double down on margin. After all, you are a genius, right? Wrong. In a bull market, everyone looks like a genius. A rising tide lifts all boats, even the leaky ones. The market has a way of humbling you exactly when you feel invincible. I have run those numbers myself, looking at my own trading history. My biggest losses always came right after a string of wins. I got cocky. I thought I could time the market. But the reality is that not even professionals can time the market consistently. The best hedge fund managers in the world get it wrong all the time. To avoid the overconfidence trap, you need to rely on data, not your gut. Your gut is great for deciding what to eat for lunch, but it is terrible at probability. Use data-driven strategies like dollar cost averaging to remove the element of timing. Periodically review your results and be honest with yourself. Did you make money because you were smart or because everything went up? If you can't tell the difference, assume it was luck. Diversify rather than getting swayed by one-off wins. It keeps your ego in check. When you measure your performance against a benchmark like the S&P 500, it is a humbling experience. Most active traders underperform the index over a 10-year period. Accepting that you probably aren't the exception to the rule is the first step toward actual profitability. It allows you to use proven strategies rather than trying to reinvent the wheel. Put your ego in a box and lock it away. Investing is not about being right, it is about making money. Those are often two very different things. This segues perfectly into mistake number 6, ignoring risk management. Failure to match investments to your actual risk tolerance is a recipe for disaster. We all think we have a high risk tolerance when the sun is shining. But risk tolerance isn't about how you feel when you are making money. It is about how you sleep when you are losing it. New investors often take on volatility that is financially or emotionally unsustainable. If you need your money in 2 years for a down payment on a house, putting it all in stocks is reckless. If the market dips 20%, your house plans are ruined. That is poor risk management. You have to assess your appetite honestly. There is also a geographical component to this. Being aggressive with your portfolio feels very different if you are living paycheck to paycheck in an expensive city like New York, compared to having low overhead in a place like Dallas. Your life circumstances dictate your risk capacity. You need to set guardrails. Use stop losses or position sizing to limit potential damage. If you decide beforehand that you will never lose more than 5% on a single trade, you prevent one bad decision from wiping you out. Another critical part of risk management is the boring old emergency fund. Before you invest a single dime in the market, you should have cash set aside for life's unexpected surprises. The transmission blows, the roof leaks, the medical bill arrives. If you don't have cash, you will be forced to sell your investments to cover these costs. And Murphy's Law dictates that you will be forced to sell them at the worst possible time, when the market is down. The emergency fund acts as a buffer. It protects your portfolio from your life. It gives you the staying power to ride out market volatility without panicking. It allows you to look at a market crash as an opportunity rather than a crisis. So, assess your risk, set your limits, and keep a cash cushion. It isn't sexy, but it keeps you in the game. And in investing, survival is the prerequisite for success. Now let's scale this up. What happens when your portfolio hits $1 million and you have no exit strategy? This brings us to the final mistake: not having a long-term plan. Many new investors are just reacting. They buy because they have extra cash. They sell because they need a new car. It is reactive, not strategic. Without a plan, you are just drifting. You might be making money, but are you efficient? Short-sightedness leads to wasted opportunity and, crucially, higher taxes. If you are trading frequently, you are likely triggering short-term capital gains tax, which is taxed at your ordinary income rate. That can eat up 30 or 40% of your gains, depending on where you live. A long-term plan considers taxes, fees, and your changing time horizon. As you get closer to retirement or your goal, your strategy should shift. You should be gliding from accumulation to preservation. If you don't have that map drawn out, you might find yourself taking massive risks right when you should be playing it safe. Define your horizons. Are you investing for 5 years, 10 years, or 30? Write down your savings goals and your withdrawal plans. Avoid excessive trading to minimize those transaction costs and maximize your compound interest. Review your plan regularly, maybe once a year, and adjust it as your life changes. Did you get married? Have a kid? Lose a job? Your plan needs to breathe with you, but the core principles remain the same. New investors often fall prey to emotional swings, tempting trends, poor planning, and a lack of risk discipline. By learning to avoid these 7 costly mistakes, you lay the foundation for enduring financial success. You move from being a gambler to being an owner. Patience, knowledge, and diversification are your greatest allies. Use them wisely. And speaking of using things wisely, I want to hear from you. Which of these mistakes have you made? I've made at least 3 of them. Drop a comment below. Think of it as peer review for the community. And if you found value in this deep dive, make sure you are subscribed so you don't miss the next one. Thanks for watching.